Welcome to the Pro Ticker Deep Dive.
For, gosh, almost 2 years now, the luxury sector has just been stuck in what felt like absolute market purgatory.
Brutal headwinds, right?
Brutal. We're talking about the longest sustained sector-wide contraction in more than 2 decades. Everything was trending down.
It was a painful environment.
Yeah.
We were all asking, not if the bad news would stop, but when. When would the market finally find a floor?
And then it did, October 15th.
LVMH. It delivered this shock 12% rally in one day. And it wasn't some trading glitch. It felt like a psychological pivot for the entire sector.
It was the market just screaming, the worst is officially behind us. So today we need to dive in and figure out if that was just a short-term bottom bounce.
Or something more.
Exactly. Is genuine, sustainable recovery momentum actually building? So our mission is to unpack the big four: LVMH, Hermès, Kering, and Richemont, and see who's really best positioned to ride this new wave.
Okay, let's start with the root cause of all this pain. The macroeconomic backdrop. This whole brutal downturn really kicked off because of what was happening in China, right?
That's where the pressure started, absolutely. China's luxury market is just immense. It accounts for, roughly 30% of global spending?
So when that market contracts,
The whole sector feels the chill, and it contracted sharply. We're talking 18, maybe 20% in 2024 alone.
and it wasn't just a simple slowdown. The sources are pretty specific about the property crisis being the main culprit.
Yeah.
Why did sinking real estate values choke off luxury spending so effectively?
It's all about consumer confidence. It just destroyed it, particularly for a really crucial group, the upper middle income households.
The aspirational buyers.
Precisely. The ultra-wealthy, they're usually fine, they're insulated. But these aspirational buyers, they rely heavily on feeling wealthy and stable. When their biggest asset, their home, suddenly looks shaky, the first thing to go is that new Louis Vuitton bag.
And that chokes the whole system.
And the problem was compounded globally. You had geopolitical uncertainty, tariff fears bubbling up.
And the travel factor. As travel came back, wealthier Chinese tourists started buying overseas again.
Right. They'd go to Europe or Japan where prices were better. So that pulled domestic Chinese sales down even further. It was, a perfect storm.
But that storm finally seems to be breaking. We saw a subtle shift starting in the third quarter of 2025.
We did. The Chinese authorities intensified their stimulus measures. And, more importantly, we started to see signs of stabilization in the property markets, especially in major cities like Shanghai and Beijing.
The first green shoots.
And you saw it in the consumer sentiment surveys. Higher income households, the engine for luxury, were signaling a renewed willingness to spend. It wasn't a roaring rebound, we have to be clear.
No, not at all. But it was the first positive signal we'd seen in a very long time.
And if you look at the bigger picture, this wasn't just a China story. The stabilization was pretty broad. The U.S. consumer stayed surprisingly resilient.
Europe held steady.
And Asia, outside of Japan, showed real, meaningful improvement. That geographic breadth is critical. It suggests the whole global cycle for luxury just kind of bottomed out at the same time.
Which brings us directly to LVMH, the stock that, broke the fever. Their Q3 results came out. And on paper, the numbers looked kind of modest.
They looked flat, but the market reaction was explosive.
So why did a modest result feel like a boom?
It's fascinating. The market reacted to the rate of deceleration, not the actual growth number. LVMH's Q3 revenue was $18.3 billion, which is just 1% organic growth.
Basically flat.
Right. But the market was starved. The really crucial number was buried inside their fashion and leather goods division, their crown jewel.
That's the one you have to watch. And in Q2, that division had collapsed by a massive 9% organically.
A staggering number. But in Q3, that decline slowed to just 2%.
So they didn't stop the fall, but they slowed it to a crawl? That's a huge turnaround in momentum.
That's stabilization. Management credited new creative direction at places like Louis Vuitton, Dior, Fendi, and Celine. And that tiny turnaround immediately triggered the sector-wide rally. Hermès jumped.
Up to 10%. Kering surged nearly 10% too.
The whole narrative just shifted overnight from, how bad will it get, to, okay, is growth back on the menu?
So we know the tide is turning. But not all these giants are in the same boat, and they are definitely not valued the same way. Let's talk about that divergence, and let's start with Hermès, the ultimate luxury hedge.
Hermès is the definition of a fortress. They sailed through this downturn almost completely unscathed. Their Q3 revenue was strong, up 9.6% at constant exchange rates.
And their core engine, leather goods and saddlery, surged 13%.
Their strategy is just completely unique. It's all about scarcity. They strictly limit their production growth to a tight 6 or 7% a year. They don't chase volume.
They preserve exclusivity. It's why they keep their pricing power.
But here's the catch for an investor. That resilience comes at a cost. The stock trades at a huge premium. We're talking a 27 to 30 times forward multiple. The sector average is more like 18.
They're priced for perfection.
Absolutely. And we saw proof of that recently. They had a modest miss on consensus estimates, and the stock immediately pulled back 4 or 5%.
It shows how unforgiving the market is at that valuation.
It really does. So they are the anchor, the quality name. But the risk of that multiple compressing is real if this recovery stumbles.
Okay, let's pivot from perfection to the massive turnaround story here. Kering. They were in the deepest hole of all of them.
Oh, yeah. Kering is the high-risk, high-reward asymmetric play in this space right now. Their Q3 revenue was still a 5% comparable decline. So yes, still negative. But that was a stunning improvement from the 15% collapse they saw in Q2. They stopped the bleeding, even if they're still bandaging the wound.
And this signals that the CEO, Luca De Meo, his massive turnaround strategy is finally getting some traction.
Yep.
He's been really aggressive, closing underperforming stores, rethinking wholesale.
And trying to reignite that creative fire at Gucci, which is so crucial for them.
And we are seeing some early success there.
We are. At Gucci, the retail sales decline narrowed from a brutal 25% in Q1 to 13% in Q3. Yves Saint Laurent stabilized at negative 4%, and Bottega Veneta actually got back to positive 3% growth. These are the little wins De Meo needed.
Now, let's talk valuation, because this is what makes Kering so interesting. It's trading near 10 times EV/EBITDA. Can you just quickly break down what that means and why it creates asymmetric upside?
Sure. So EV/EBITDA is just a way of looking at a company's total price relative to the cash it's generating before you factor in things like debt or taxes. At 10 times, Kering is just cheap compared to its peers.
And that cheapness creates the asymmetry.
Exactly. It means your potential reward is much, much higher than your potential risk. If De Meo's reset works, the stock could soar maybe 50 or 60% just to get back to the sector average.
And if it fails?
It might fall another 10 or 15%. That imbalance between the potential gain and potential loss makes it a really compelling, though definitely speculative bet.
That makes perfect sense. Okay, last one of the big four, Richemont. Often the quiet outperformer.
Richemont offers stability. They benefit so much from their diversified portfolio, especially in high-end jewelry and watches. Their first half results were robust. 10% sales growth, and operating profits surged 24% without currency effects. They're just not as volatile as the fashion brands.
And they have a ton of financial firepower now, right? After that major restructuring.
A colossal amount. After selling off YNAP, that's their e-commerce division, that was kind of a drag, their net cash surged to $6.5 billion.
Wow.
That cash gives them huge operational leverage, they can make acquisitions, and critically, it gives them downside protection if the economy gets worse again. They are a strong recovery play with a much better balance sheet.
So the bottom is confirmed. Now, looking ahead, what could propel this sector out of this, limping phase and into a real roar?
Yeah.
Let's talk about the bull case, starting with this idea of a creative supply shock.
This is where it gets really interesting because it's not a macro factor. Analysts are pointing out that there are more new creative directors launching major collections right now than at any time in the past 3 decades.
We've seen big changes at Celine, Dior, Gucci. So why does the sheer number of new collections matter so much?
It fundamentally changes how people buy. When collections are stable, customers buy the classics, they refresh a piece here and there. But when you have this huge influx of fresh creativity...
New silhouettes, new ideas.
Right. It encourages the customer to buy more items. They're layering, they're experimenting, they're completing new looks instead of just hoarding classics. This creative shock could drive both volume and margin at the same time.
And you couple that with the potential for China to finally normalize. That's a multi-billion-euro catalyst right there.
It's a massive tailwind, but we have to balance that enthusiasm with the bear case because this recovery is still so fragile. Some analysts have noted that China's recovery is extremely cautious. Credit growth is slowing down, and the improvements are really concentrated in just a few wealthy coastal provinces.
So the fear is that this could just be a blip.
Yeah.
That the recovery doesn't spread.
Exactly. The consensus is still that China's domestic luxury market will be negative for 2025 overall, with only modest growth returning in 2026. If the stimulus fails, the premium built into these stocks just collapses.
And then there's a pricing issue.
Right. From 2019 to 2023, these brands relied on aggressive price hikes. But customers are now pushing back. There's real resistance. So it's very hard to expand margins now without truly compelling innovation.
Which brings us back to the reality check on LVMH's valuation. It kicked off the rally, but it's trading at 27.7 times trailing earnings. The sector average is 18.5. That's a huge premium.
It is a 66.7% premium. You could argue it's justified by their dominance, but it's a risk. The market is pricing in a massive rebound already. If that recovery slows, the valuation compresses sharply. You're paying for a future that hasn't happened yet.
So let's wrap this up with a quick look at the technicals for LVMH. That rally was intense, a 39% surge from its August low to that October peak. Where does it stand now?
Well, that immediate momentum is gone. The stock is now consolidating, sort of hovering around the 610 to 620 range. The medium-term trend is still positive, so the bottom is in.
But to hit new highs.
It needs fresh catalysts. We'll have to wait for the Q4 update or the guidance they give in January.
Okay, so let's put it all together. The bottom is in, but we're limping back, not roaring back. What's the final strategy here?
For Hermès, it remains the premium anchor. It's worth holding if you can tolerate that high multiple. Kering is your binary bet, that asymmetric risk-reward play on the turnaround succeeding.
Richemont is the steady hand, the value play with that great balance sheet.
And LVMH, it's a hold for core positions. The psychology has shifted to buy on the dips, but if you're putting new money to work, maybe wait for this consolidation to resolve itself.
You know, that psychological shift is really the most fascinating part of this story.
It really is. I mean, think about this for a second. Right now, analysts are arguing over whether the luxury sector will grow 5% in 2026 or 3%.
A 2 percentage point difference.
Yes, a 2-point difference 18 months from now is what's fundamentally changing how these multi-billion-dollar companies are valued today. That anticipation, it's fueling everything we're seeing.
It really shows how desperate the market was to leave that purgatory behind.
Indeed.
See you all in the next Pro Ticker Deep Dive.